What's going on, money lovers? Welcome back. Very excited today to share with you these 5 high-yielding dividend stocks, the highest of which yields 12%. We're going to get to today, and we're going to be talking about some stocks and ETFs. So starting with the lowest yielder, Johnson & Johnson, one of my favorite, if not my favorite, dividend stock of all time. This is basically like owning a healthcare index fund in and of itself. They are so well diversified, from medical devices to vast pipeline of pharmaceutical drugs, the many consumer products you probably will find in your home. So J&J is down a little bit. They have been facing some lawsuits about their sunscreen, and if it does continue to go down, I will definitely start buying more. This is a company, current PE sits around 29. It's very rare that Johnson & Johnson really goes on sale. This is a company that just keeps trending up and to the right. As you can see, this is a buy and hold forever. Pays a dividend of 2.49% or $4.24 with a market cap of $444 billion. I've made videos on Johnson & Johnson in the past. Check those out if you're interested in. This is a company that I believe belongs in every portfolio. All right, dividend paying stock number 2, Clorox Company. This is a company I've had on my watch list for a long time, and I just recently started a position that I'm currently working on building up. Clorox is another fantastic hold forever company. PE currently sits around 25, and in a market that, many will argue is overvalued right now, I'm really looking for value and focusing on my dividend plays to get my cash flows up. Pays a dividend of 2.57% or $4.64. And as you can see, it's down quite significantly from the highs here. So obviously at the peak of the pandemic, you couldn't even get Clorox wipes. So it's down about 20% since those highs. So I think this is a fair buying point here. And this is a company I just also recently made a video on. Check that out if you're interested in. Very well diversified, market cap of $22 billion. They've got international sales. They've got a diverse line of products. I really like the Clorox company. And again, as you can see, this is a company that over time just keeps going up. All right, next up, this is an ETF, and this is our number 3 stock for today. The Schwab US Dividend Equity ETF, ticker symbol SCHD. I've gotten questions about this in the past. I've also made a video on it. There's another ETF that just gradually continues to increase while paying a nice dividend yield of 2.89%. Got $26 billion of assets under management. Now, this is another one that I've never pulled the trigger on. I think they're down the line. I'm 24 years old. I am focused on growth right now as well. I don't want to sacrifice too much growth, but I do want to have, a decent amount of cash flow. But when I look at the top 10 holdings in this ETF, these aren't names that particularly excite me that I would buy individually, except for maybe, Home Depot is definitely on my watch list. I do like PepsiCo, and I own some Pfizer. But other than that, Verizon, Cisco, Merck, Texas Instruments, these aren't companies that make me jump for joy. I mean, they are great companies, don't get me wrong, but I just don't see the growth prospects really there. So me personally, I'm more focused on a regular, total market index fund because I just think it's going to get me better returns. And then eventually when I get to the point where I have enough money invested where I feel comfortable, I could see myself switching over, a decent amount into something like an SCHD to just sleep easy at night, get consistent, reliable cash flow. So these top 10 holdings here are definitely great if cash flow is your goal, but probably not the best options if you're looking for more growth. Like I said, I wouldn't buy some of those companies individually, but I wouldn't mind owning them through this dividend ETF, which pays a nice yield of nearly 3%. And again, as you can see, just gradually continues to rise. Next up, number 4, XYLD, the Global X S&P 500 Covered Call ETF. So they own the 500 companies of the S&P 500, and they sell covered calls on them to generate the yield. They pay a 10% yield, $334 million of assets under management. Again, this one you're not going to get a lot of capital appreciation from, and it probably would serve you well to, wait for a pullback to lock in a better yield. We go back to the worst part of the crash here, it was all the way down to 37. So again, it doesn't get drastically affected like the broader market. It was down, let's say, 25% from its high, and now it's back up to basically where it was pre-pandemic. But with this one, you get the 10% yield, and I think that this is a great company, especially if you're just starting out and you want to really experience dividend investing and get a great yield. And because sometimes it is difficult when you start and you're getting a 1% yield or a dollar dividend here and there, it doesn't seem like much and it can be discouraging. So mixing in something like this can really help you to start fast tracking your income and then use that cash flow to buy great companies or pay your bills. They've got an expense ratio of 0.6%, and that's well covered by the nearly 10% yield. So this basically is good also for if you're someone who you're interested in options, but you don't want to commit the time. This is a passive way to get options income coming in. I actually just started a position in XYLD today. I like this fund. I think it's well diversified, exposure to these 500 S&P 500 companies, which brings us to number 5 here, our 5th high-yielding dividend stock, QYLD, or the Global Nasdaq 100 Covered Call ETF. But here you're a little less diversified as it's only on the Nasdaq 100 companies. Got $3.3 billion of assets under management though, so it shows the immense popularity. The S&P 500 Covered Call ETF only had about 330 million, which is very surprising to me. Now, it does pay a yield of nearly 12%, which is incredible. That comes out to almost 1% a month. You could expect hitting your bank account. Try getting that in any savings account or CD. And as you can see here, now it has historically been losing value. I just want to pull up a better chart here just to show you. So if we go all the way back to 2014 and we go to now, it has lost about 13%. Now, I've heard people saying that, you know, they fixed their algorithm so it shouldn't lose value now moving forward. Even if it does stay flat or loses a little bit of value, as long as they are able to continue paying that 12% yield, it'll well, you know, cover this. Because over the last, let's say, 7 years, the fund lost 13%, let's say, but you made 7 times 12, help me out here, about 84%. So you're still coming out way ahead of the game, and I think this is a great complement to, you know, regular index funds you may have in your portfolio, as it gives you reliable, thus far reliable, put that word in parentheses, cash flow. Hopefully, if we do have, you know, major turmoil, this would hold up and they would still be able to pay a significant chunk of this dividend yield, if not the entire thing. So gives you something you can rely on, hopefully, during hard times. All right, guys, if you enjoyed the video today, don't forget to like and subscribe. It really means a lot and helps out the channel. Let me know what you think in the comments below. What do you want to see more of in the future? Have an awesome weekend, everyone. Enjoy the beautiful weather. This is Vinny from the Investment Club, and I'll see you.